Walk into any bank in America. They'll greet you. They'll thank you for your business. They'll tell you they appreciate having you as a customer. They don't. In their actual business model, you are not the customer. You are the product. The customer is the institution on the other side of every transaction the bank makes possible. You are the asset they monetize. Today, the banking industry is on trial. 7 specific lies your bank tells you about how it makes money and what your role in that system actually is. By the end of this video, you're going to know more about your bank's business than the people who work the counter. Sit down. Court is in session. Welcome to Capital Court. I'm not a financial advisor. I'm not on television. I don't work for any bank. And after this video, you'll understand why I don't keep my money in one either. If you want to understand the system that runs your financial life, hit subscribe. New case every single day. Now, the defendant, the American banking industry, 7 lies. Let's begin. Exhibit A. Lie number 1. Banks lend out your deposits. This is what every introductory economics textbook says. You deposit $100. The bank keeps 10 in reserve. The bank lends 90. That 90 becomes someone else's deposit. The cycle continues. This is called fractional reserve banking. It's not how modern banks actually work. Modern banks create deposits when they make loans. They don't wait to collect deposits and then lend them out. When you sign a mortgage, the bank doesn't pull your money from someone else's checking account. It creates a new deposit in your name, on the spot with a keystroke. The constraint on bank lending isn't deposits. It's capital requirements and credit demand. Your savings account doesn't fund new loans. It funds the bank's float, which the bank invests for itself. The verdict on Exhibit A, guilty. Exhibit B, lie number 2. We pay you interest because we want to reward your savings. The average savings account in America pays around 0.4%. The Federal Reserve overnight rate sits above 4%. The bank takes your deposit, lends it to other banks overnight at the Fed rate, and pockets the spread. That's not rewarding savings. That's pocketing the difference between what your money is worth and what they pay you for it. The spread is the business. Your deposit is the input. If banks wanted to reward your savings, they would pay you something close to what the money is actually earning. They could. They don't, because every basis point they don't pay you is a basis point of profit for them. The verdict on Exhibit B, guilty. Exhibit C, lie number 3. Overdraft fees are necessary to cover the cost of processing. The actual cost to a bank of approving a transaction that overdraws your account by a few dollars is essentially zero. The fee charge is typically $35. Overdraft fees are not cost recovery. They are a revenue stream. American banks collected over $30 billion in overdraft fees in 2023. The vast majority came from customers whose average balance is under $500. The poorest customers fund the most profitable revenue line. The bank designs the timing of transaction processing to maximize the number of overdrafts. Withdrawals get processed before deposits when both arrive on the same day. That sequence is a choice. It's a choice that produces overdrafts. The verdict on Exhibit C, guilty. Exhibit D, lie number 4. We're FDIC insured, so your money is safe. True, with limits. FDIC insurance covers up to $250,000 per depositor per institution. Most retail customers are well under that limit, so in theory, your money is safe. In practice, bank failures are messy. In 2023, Silicon Valley Bank and First Republic failed. Depositors above the insured limit were made whole because the Fed and the FDIC decided to step in. But that decision was discretionary. It set a precedent without writing it into law. If your bank fails and the Fed decides not to extend the same protection next time, depositors above the limit lose. Even for depositors below the limit, the FDIC process can take days to weeks to access your money. During that window, your bills don't stop. The verdict on Exhibit D, guilty. Exhibit E, lie number 5. We compete on rates and service. Major banks watch each other. When one drops a savings rate, others follow. When one introduces a fee, others mirror it. The pricing across major institutions is remarkably uniform. That's not competition. That's an oligopoly with coordinated behavior. Real competition would mean meaningful differentiation in deposit rates, fee structures, and service quality. You don't see that across the top 10 banks because there's no incentive for it. They all charge similar prices because customers don't switch easily. The switching friction is the moat. The verdict on Exhibit E, guilty. Exhibit F, line number 6. We're here to help you build wealth. Look at the banking industry's actual customer base by profitability. The most profitable customers are not the ones building wealth. They are the ones carrying revolving credit card debt at 20+% interest. The ones who overdraw periodically, the ones who maintain low balances and pay monthly maintenance fees. The least profitable customers are the ones who pay their balances on time, keep large deposits, and never overdraft. The bank loses money on the most financially responsible customers and makes money on the ones who are struggling. Banks are not aligned with your wealth building. The bank's profit increases as your financial position weakens. That's a structural conflict of interest the industry has never resolved, because resolving it would reduce profits. The verdict on Exhibit F, guilty. Exhibit G, line number 7. Your relationship with your bank is personal. It used to be. In 1980, there were about 14,000 banks in America. Today, there are about 4,000. The 4 largest control over 40% of all deposits. When your local branch closes and your accounts get transferred to a regional service center, the relationship is not personal. It's transactional. Your customer service representative is a contractor reading a script. The decisions about your account are made by algorithms running on systems you can't see. The personal relationship narrative is marketing. The actual operating model is industrial scale, automated, and engineered to maximize fee extraction per customer. The verdict on Exhibit G, guilty. So what does all of this mean? Your bank doesn't work for you. It works for itself and its shareholders. You're not a customer. You're a source of low-cost deposits, an opportunity to extract fees, and a borrower who can be charged spread. This isn't a moral failing. It's a business model that's been industrialized over 40 years. The decisions that produced this outcome were made deliberately. Branch consolidation, fee proliferation, algorithmic decisioning, they all maximized return on equity. The cost to customers was a side effect the system was happy to externalize. Here's the part most people miss. You have options. High-yield savings accounts that pay over 4%. Treasury direct purchases that let you skip the bank entirely. Credit unions where the customers are technically the owners. The major banks count on inertia. They count on you not moving your money because moving is annoying. If enough people moved, the major banks would have to compete on rates instead of fees. That's the leverage you actually have. You weren't supposed to understand the business. That was the design. The verdict of this court. The American banking industry has industrialized customer extraction. Your money is the raw material. Your inattention is the moat. Now you know. If this changed something for you, hit subscribe. New case every day. Tomorrow we put the stock market on trial. Specifically, we ask why the market goes up when unemployment goes up. The answer is going to make you angry. While the bank takes from your wallet, here's one thing you can do today. In the description below, you'll find a high-yield savings account that pays more than 10 times what your bank pays you. Affiliate link. Use it if you want to support the channel. Court is adjourned. See you tomorrow.